We'd reached a really interesting time for our business where, if you think of our category, it didn't really exist. So people knew what a Fitbit was for themselves, but they didn't necessarily knew that one would exist for their dogs. So we had, I'd say, quite an interesting marketing challenge where if you're launching into an existing category, there's existing demand already. So if you're selling a toothbrush, there's people searching for toothbrushes. We didn't have that search demand, so we needed to kind of go out and actively generate demand and awareness. And TV is one of the channels.
I'm Diana Florescu, and this is the Media Capital Show. Up next, we have Andrew Nowell, the CEO and co-founder of PitPat, a company known in the market as the Fitbit for dogs. A few years ago, when Andrew started PitPat, he faced a unique marketing challenge. He had to create an entirely new market category for his product. While performance ads and SEO can take you a certain distance, they might not always be the most effective channels, especially when competing against billion-dollar pet care brands. Andrew successfully raised multiple rounds of media capital from ITV and UKTV to boost PitPat's visibility and drive growth. We talked about his learnings from their first TV campaign, how he convinced existing investors to say yes to media capital, and what's next for PitPat. Hope you enjoyed. I just want to dive straight into it, and I would love to start with the story behind PitPat and just briefly tell us how you started the company and how you got to where you are today.
Yeah, no problem at all. So I'm Andy Nowell. I'm the CEO and founder of PitPat. My background is engineering, so I was always a bit of a geek at heart growing up. I spent 6 years leading engineering consultancy after university, designing a whole host of products for other companies, and managed to work on some of the first human wearables of the type you kind of wear on your wrist, and found that really, really interesting. And I'd also kind of been an avid dog lover my whole life. And I'd kind of seen how wearables had helped kind of humans get fit, exercise more, focus on steps, the change in behavior, and the positive impact it could have. And thought, why has nobody done this for pets? Even more so, pets don't have a voice, they can't tell you how they're feeling. You're very much in their control. Why not do a wearable which can help keep your dog happy, healthy, and safe? That was around 8 years ago. Quit my job. Was very fortunate to have some amazing co-founders who wanted to join the company with me. And then, yeah, we set out to build the lowest cost, longest battery life dog activity monitor, or Fitbit for dogs, as you could call it. The first few years of the company were really kind of focused on the gnarly technical development of how do you do this. Dogs are really hard. They have 4 legs, people have 2 legs, and there's less variation. If you think you have around 250 breeds, from tiny Chihuahuas to massive Great Danes, it actually is really hard to do a good dog wearable. So the first kind of 2-3 years were really just establishing that we could do it, getting the MVP to market. And then we began kind of looking at media for equity and other kind of business models when we were really ready with the product and we'd made our first sales. And in 2019, we did our first media for equity round with UKTV. We learned a lot from that campaign, which I can touch on later, and then kind of continued as a business. And then more recently, we've just done another funding round at Series A, where again, media for equity is a big part of it, this time bringing on ITV and UKTV Ventures as well.
Yeah. I mean, yeah, so I was just about to say you've done multiple media for equity rounds. I guess when you first started, how did this even come about? What was it that you were looking for? And
Yeah.
how did you find out about that this model actually exists?
So we actually found out about the model through our network. So it was one of our investors who kind of introduced us and told us about it. We'd reached a really interesting time for our business where, if you think of our category, it didn't really exist. So people knew what a Fitbit was for themselves, but they didn't necessarily knew that one would exist for their dogs. So we had, I'd say, quite an interesting marketing challenge where if you're launching into an existing category, there's existing demand already. So if you're selling a toothbrush, there's people searching for toothbrushes. We didn't have that search demand, so we needed to kind of go out and actively generate demand and awareness. And TV is one of the channels that has the biggest reach and also the biggest kind of trust. So for us at that point, it was really, we need to create a category. We want to become the one. Like, most people now think of wearables as Fitbit and the Apple Watch. They even call it a Fitbit. we wanted to make sure that people would call it a pit pat when they were thinking of something they'd put on their dog. So we wanted to kind of really own the category. And I think that was one of the areas where we were successful on our campaign, is that we had more people searching for PitPat than they did for dog activity monitor, to the point where we would kind of really own that category and kind of build the awareness. One of the big things we learned from the first campaign is just really understanding your lifetime value, and also the fact that TV doesn't necessarily have all of its impact in the first year. It really is long tail. You'll see this massive kind of raise in awareness to start off with, but then it will kind of decay over the next few years, but quite slowly. And actually, you get the uplift over several years, not just immediately. And that's very different from digital channels, where you see the effects a lot quicker, but then they almost disappear to the point where you stop the Facebook ads or you stop the TikTok ads. So, if anything, we needed to had to be able to continue and really grow. And at that
Yeah.
point, we had one product. It was a £39 activity monitor, and you have to sell a lot of £39 activity monitors. So one of the things we kind of realized is that this is great, people love it, but to justify the investment and to continue that investment, we needed to have a higher lifetime value. And
Yeah.
that was really a kind of pivotal stage for our company, where we started doing other things such as pet food, GPS trackers, and expanding our range.
Yeah, I guess we did actually talk about this before, about managing expectations when you go into a media for equity deal or when you're using TV. Because I think TV is a way to diversify your marketing budget, but it may not buy you immediate installs or conversions or
Yeah.
revenue. But I think it helps just keep the brand, on consumers' mind, and sometimes it might even help with price sensitivity, especially in a market that in the recessionary environment, for example. How did it help PitPat? I think you mentioned about people searching for PitPat. I think there was a lot of unprompted brand awareness behind it as well when they think about Fitbit for dogs,
Yeah.
and they immediately think about PitPat. But from your, I guess probably the recent ITV investment, it's a bit too early, I guess, to think about, because it only happened a couple of months ago, I suppose. But from the investment with UKTV and that experience, what was sort of the learnings, or what have you seen from that TV
Yeah,
campaign?
so we measured brand awareness before and after the campaign, and it definitely did go up. It almost tripled. So it kind of did its job in that respect. I think the long learning for us was that it would continue over many years, and that when looking at your payback period for TV, you can't just do it in the period you're doing TV. You have to do it in the 1, 2 years afterwards. And because we had quite a break from TV from kind of 2019, 2020 to now, we can see that in our search data and our other data, that without that, it's kind of slowly kind of decreased over time in isolation. So that was a really good test for us. I think one of the other things we learned is you really need to understand who your competitors are, and they may not be your direct competitors. Let me give you an example of that. So for us, we didn't have many other people doing dog activity monitors. But there's lots of people trying to sell stuff to pet owners. There's lots of food brands, insurance brands. And actually, that makes pet a really expensive audience to go after on something like Facebook, because the pet market is a premium. And you're competing against, say, a food brand who has a lifetime value in the thousands of pounds. While they're not a direct competitor, or they weren't at that time, they're still going for the same eyeballs. They're still bidding on the same person, and that's going to elevate your CPCs irrespective of whether they're a direct competitor or not. So we were starting to look at who the really big pet brands were and what share of voice they had, particularly in the kind of big stage of TV. And you'd see it was the most successful brands, the Pets at Homes, the big insurance companies, the big food companies, who were really investing in that media. And our ambition is to get to the same kind of awareness level where we are one of the top 5 pet brands in the UK. And you need to have that share of voice, you need to have that trust. So for us going into the next campaign, it was 01, we're just planning. Everything has been measured upon what do we need to do to get the share of voice amongst pet owners, to make sure that we are one of the prominent ones, if not the most prominent one, to make sure we're winning those customers for our product.
Yeah. How did you know that you were ready for a TV campaign back then when you first started with UKTV? Or what were the things that an investor as such was looking at in
Yeah.
terms of unit economics?
Yeah, I think it was just understanding where your acquisition cost was to start off with. And I think you mentioned in the kind of introduction, you will definitely see your digital CPAs dropping when you put this kind of above the line media in. So I think it was understanding that and what the expected payback period was. If I'm honest, I think we were a little bit too early for TV the first time we did it with the single product we had, but it kind of taught us what we needed to then know kind of going forwards what we wanted. And I think we went with UKTV to kind of start off with because they're a smaller network than some of the others out there. And if
Yeah,
you've got a limited budget with a smaller network, you can get more reach for the same amount of budget. So it really was kind of a testing ground for us to really understand the effects, to then build a business case to then go again. And we kind of have raised 4 times as much this time.
yeah.
But are also going for bigger networks, but we kind of understand better where we're starting from.
Yeah. I guess to what respect the upcoming campaign with ITV differs from UKTV from a objective point of view? Would you say that the first one was more about brand awareness, brand building? This one now, because you've done it already, you build that awareness, is more direct response, or
Yes and no. So again, you really have to understand what job you want the media to do, and I think that's critical. You can't just use TV like a pure demand response channel, especially on certain networks. For
yeah,
us, quite a lot of the original goals are the same. It is about building trust, getting share of voice, building awareness, with also having this sales focus, but that is around priming the top of funnel for the then conversion digital channels to really fly. And a lot changed for the business since the first kind of time we were on TV. We now have a GPS tracker, which is a more expensive product, £149, a lot more search demand for that because people do have a fear of losing their dog. This is a category they understand more. So when we were launching GPS, it wasn't we need to be on TV straight away. It was launch, get on paid search, see where our baseline is on just people searching for I've lost my dog or dog GPS tracker. We're now at the point where we've got a really good share of search. We know where our CPAs are. There's a set amount of people who are losing their dog and then going and searching for it. That's really well understood. The job for TV now as well, actually, there's a load of people who don't realize they could lose their dog or haven't got a fear of losing their dog. They could be in the market, but they're not in market yet.
yeah,
And through TV reaching the masses, raising that awareness that this is a problem, even the best trained dog can run off, and kind of priming them such that when they have that fear or there's an event with their dog that they know where to come and it's PitPat. So
yeah,
it will drive sales, but it's how do you fill that top of the funnel by raising awareness at the same time.
yeah,
But we do have a mix. So we still have UKTV who are more, I'd say, kind of DRTV focused, and we have ITV who, again, with their reach, biggest network, we're going to be doing more like peak spot brand building with them compared to potentially more conversion driven on UKTV.
yeah. And I guess it probably goes both ways. I know you started to explain how well you're using the digital channels to sort of like guide you in terms of your TV campaign, but a lot of the traffic coming through these TV campaigns, you're probably going to use remarketing and eventually, lead to a conversion or a sale down the line. I guess one of the things we often see, or they are very misunderstood, is that you don't have to stop spending on digital channels when you do a media for equity
No,
campaign. Again, that's that part of the mix.
if anything, you should be spending more because you've got
Yeah,
all of that traffic to like people will start bidding on you. You need to make sure that they're searching for you or they're going direct to your website and that you have to pay for that click. So,
yeah,
if anything, you should be expecting to put more money into your digital channels to kind of harvest the demand and to your point, kind of go into that retargeting loop because it's very rare someone sees something for the first time on TV and goes, I'm going to buy it straight away. I wish that was the case, but there is a consideration period, or you need to have that frequency of seeing it enough times, seeing it on another dog, having your dog walker or your groomer recommend it to you. That there's kind of multi-touch points, but
Yeah.
just having that kind of top of funnel awareness drives everything else.
Yeah. And I guess we very often get this question, and this is just a random number, I suppose, but what does £1 million media for equity give me? And in your case, maybe reflecting back at the previous experience, what does that actually give you? Because it's not just the advertising space, is it?
Yeah, really good question. I suppose it does depend on what your product and service is. Like if it's a well-known category already, I think it would probably give you more than a completely unknown category, and that may be kind of slightly counterintuitive. We have to, for us, we have to have a certain number of interactions before they even recognize PitPat or even recognize what the product is doing. To give them a kind of more literal answer, it's tens of thousands of visits to your site, tens of thousands of prospects, awareness with the nation, probably 5-10% of people you'll hit enough times to really kind of be known. Sorry, that's a bit of a woolly answer, but it's quite a
No,
hard
no,
one.
no, it makes sense. I guess it's also where I didn't provide enough context, but what I was going with the question as well, and it's very hard to answer on such a generic, like
Mm.
without giving you an industry or anything specific. But in terms of the actual collaboration with the media partners, were there any other, I don't know, other expertise or supports in terms of making that investment happen, other than just the simple transaction of advertising value for equity?
Yeah, I mean, obviously a lot of help with media planning. I think that was one of the most helpful things for us, being quite new to the channel, just really understanding the ins and outs of it. With its optimization as well, we use Adelyzer to attribute our TV traffic. And then from that, in our last campaign, we achieved around a 15% optimization by changing time of day of week, which particular programs you're going next to. And that was a collaborative process from kind of looking at the data, speaking to the network, understanding what spots are available, and really optimizing it. And then I think just creative support as well. So we shot one of our ads, second one from our first campaign, that we used kind of UKTV. We did the kind of the concept, and then they helped shoot and produce it for us, so that they were helpful in that respect. It for us, it really is having an expert who's got a real vested interest in it succeeding on your side, to bring that kind of expertise alongside the actual media you're getting.
Yeah. I mean, it sounds like you've learned a lot and you know a lot. I suppose when you started, you didn't come in with all the different, like the knowledge that you have now. Even like, I don't know, I have to run my ad through Comcast to make sure that
Mm.
Clearcast, sorry, that make sure that it's in line with the guidelines, I suppose. Was that something that scared you when you started? Did you feel like you needed more support from the partners?
I don't think it was particularly scary, because we knew we had a good, helpful partner to help us with it. I think the scariest part was the first few weeks, where you expect there to be this massive response and you see a lot of traffic and a lot of clicks, and then it takes time to start converting into sales, and just having someone to really kind of guide you through that and give you the confidence, I think was a really helpful one. I think for us, again, you have to have a good attitude towards it, in terms of really being a good listener and being open to really understanding the ins and outs of it. Advertising is an absolute science, and we learnt a lot very quickly through lots of conversations with experts in the area, whether they were creative agencies, media agencies, because we got things benchmarked ahead of doing the deal, kind of
Yeah.
actually doing your media plan before you commit to the media, and things like that, where from every single conversation we learned something, but then we kind of kept on building that knowledge and kind of using it to the point where I think the second time we know a lot more
Yeah.
about what we're aiming for, and what to expect.
Absolutely. And I think this kind of reminds me actually of a question that we very often get from founders. Why should I raise a media capital deal when I can just go probably out there, raise more funds and deploy the funds to cover my marketing cost? Is there really an upside to doing a media deal as opposed to raising a larger round?
Really, again, depends on the business and what stage you're at. For us, we're spending a considerable amount of money on TV now and not having the kind of agency fees, each network's different, but there's things to do on negotiating pricing for ABC One adults, for example, or other things that they can give you. That at that level of spend, getting a kind of 10-20% efficiency in doing it is actually a significant amount of money, which again could lead to less dilution. I wouldn't just underestimate the expertise as well, because if you're having to hire a media planner, if you're having to work with an agency who's going to take their commission, all of these things add up. And to also have kind of an observer on your board who is an expert on the matter and can talk to other investors around how they think performance is going, honestly, kind of good or bad, all of these different things, it just lays extra weight into the campaign. So yeah, you could raise more money and not have full control of what you spend it on. And actually, if you're earlier on, you're probably better to do that because then you have that flexibility. But if you know in your campaign that you're going to be doing £3-4 million of TV anyway, it makes sense to get that TV in the most cost effective way you can and to have someone on your side to make sure it succeeds.
Yeah. And let's talk about investor relationships. And I know this was a topic that came out in previous conversations we had. It's, I guess, specifically the collaboration and potential conflict that is happening on the cap table. And perhaps it wasn't the case with PitPat, but sometimes we see pushbacks from existing investors when a company wants to raise a media for equity deal. Have you encountered such pushbacks? And if so, how did you actually explain what
Mm.
this means to one of your
Yeah.
public investors?
I think the key thing for any media for equity deal is actually having a strong case for the media, irrespective of the equity, because I think that's the fundamental thing. You don't want to do this type of investment just to get investment. You need to have a really strong case for the media, and that kind of needs to sit in isolation from whether it's just cash buy or for equity buy, and being able to answer those questions first of why TV in the first place or why out of home in the first place, because that really is the crux of the question: is the brand at the right stage for TV? Is it the right time? Is it the most cost effective? You do realize that this could have a 3 year payback period, not a 1 year payback period. So why would I put cash into it, for example? It's all of
Yeah.
these questions where you need to say, right, actually, this is why we're going to do TV. And then once you've decided that, then actually, how do I do this in the most cost efficient manner? And that was the kind of way we approached it in our planning, was plan without any constraints. And then when you know what you want to do in that respect, whether you're going to go 70% above the line, 30% digital conversion channels, or 60% above the line, 40% digital conversion channels, when you've kind of got that set and you know what you want to spend, then look at how you can do it in the most cost effective manner, and don't do it the other way around of I just want to do media for equity because I want to raise money. It's like I want to do TV or I want to do out of home. Now, how do I do it in the most cost effective manner?
Yeah, I think it's a very interesting point that you just touched on. I don't know if you had someone from your marketing team also involved in these conversations, but very often we see that the conversations that are led by the founders and obviously dealing with the investor relationships are kind of driven with the cap table hat on and the valuation and the equity, as opposed to how much media do I actually need for my
Mm.
business and what are the objectives, where I think a CMO would mainly just make the case just from a media standpoint and approach it as a media planner. And I
Yeah,
think that still is a bit of a tension sometimes.
and I think probably one of the most effective things we've had is understanding how much your direct competitors are spending, but also to the point I mentioned earlier, your indirect competitors who are actually competitors for the same eyeballs. So the food, in our case, the food companies, the insurance companies, and I think at that point it makes, because the bigger people in the industry typically are the ones doing TV. It then really helps make the case to the investor of actually, well, this is the ambition of where we want to be. These are the people we're competing against. This is how they've done it. This is where we need to be to kind of match them.
Yeah. And I guess the next question is quite broad, Andrew, but is there anything that you know now, though, doing this media capital investments that you wish you knew back then? And I know this is extremely broad, but anything that comes to mind.
Understanding the payback time of the media. I don't think when we first did it the first time, we'd realise how long the effect was for. We thought it would be a bit more peaky and then kind of die off rather than being a bit flatter, but then last for a lot longer time. And that does have a big impact on things like cash, for example, where you may see the effect, you may spend it up front, but then you may see the effect for 3 years afterwards. That's a real, that goes against most startups in terms of how they do their cash flow planning and just kind of living day to day. So I wish I'd kind of understand that a bit better. The other one I think is just trust your gut on creative. You typically, as a startup, know your product and your customer inside out because you're really trying to serve them. And it's quite easy to get external people in who are experts, but not necessarily experts in your particular customer. And really having that kind of trust of your gut on creative, I think, is an important thing. And also
Yeah.
just knowing what the purpose is, whether you're trying to become famous, whether you're trying to actually do a demand response ad because that's what your brand needs, or there's some great books out there. One I really like is The Long and Short of It, which is like short-term effects versus long-term effects, and how more viral creatives, more humorous creatives, their effect lasts for a lot longer time, but they may not sell a product. I think prime one is like the Cadbury's Gorilla advert. Everyone remembers that advert, but did it sell a lot of chocolate in the first couple of months? Probably not, but it has that long-term effect. And it's really just understanding kind of what effect you're trying to drive with the media at that point of time. And that has to come from you, the startup, not from the creative agency.
Yeah. Do you have any tips for companies that kind of doing this for the first time in terms of how do you know that that would be a good creative? Have you, for example, have you tested yours out on digital channels before? Or?
Yeah, we have. And then there's tools like System One where you can run it through and understand the response to it. Uh, I think our most successful one has been just showing it to our staff and really hitting them with the different variations. We have a audio sting of PitPat.com. I'm not going to do it. But you, for just 3 seconds of audio, you would not want to know how many iterations we went through. And again, it's kind of trusting your gut, friends and family, finding ones who will give you brutal feedback and testing it on them. There's a lot of, yeah, just don't be afraid to get negative responses because it's better now than it is in the future. But
Yeah.
really, yeah, test, test, test.
Yeah. I think we have one question, and this is actually something that I did want to ask earlier when you talked about the stage you were at when you did the first deal with UKTV. You mentioned, so this is a question from the audience. You mentioned that you were too early the first time you've done it. What made you say that you're too early? And the question is, with what you know now, would you still have done it? And what would have done differently? Sorry, there's like two questions I think into
Yeah,
one.
I think the context of being too early is we then couldn't follow through and maintain it and keep it going. And ideally, we would have never gone off TV. We'd have been able to kind of keep it running. I think that one is a very specific one to PitPat because we had a £39 product and we were learning things all the time still that having GPS is more attractive. People are interested in food. People are interested in insurance. I would still have done it again because we had a lot of halo benefits on the B2B side. So we were doing lots of partnership deals with insurance companies at the time. They don't particularly get excited by you saying, "Oh, I'm doing a big brand awareness campaign on Facebook," versus, "Yeah, we're going to be on TV. The product you're integrating into your policy is going to be advertised on TV. Loads of people are going to see it." So it
Yeah.
really kind of drove us on as a business. It had a big effect on our revenue. It had a big effect on awareness. But the CAC to LTV calculation in the short term wasn't there. And I kind of said before, we saw the benefit for 3 years after the campaign. But that doesn't matter because cash in the future is useless. As a startup, you need cash today. So I think again, that was the learning from it of it. We weren't in that kind of CAC to LTV where we could keep on running it and have it as an always on activity.
Yeah.
So we learned that, and I think now it drove us to people love this. there still is a category awareness channels. How do you be smarter about it in terms of increasing your LTV, finding new channels, broadening our product mix? So it drove us a long way as a business, even if we weren't necessarily the perfect timing for it.
Yeah, I guess once again, it's about managing expectations. But now that you're referring back to funding, one thing we've learned through working with other brands was that, your future investors or future retailers or distribution partners are watching TV. So I don't know if that was something that you felt that it helped towards raising other rounds, or did it help in any way start a conversation with other potential investors?
I'd probably say less so investors, but other business partners. So pet
Yeah,
stores, groomers, they were coming to us rather than us having to go to them.
right. I think we are, if there are no further questions from the audience, and I do apologize in advance because we are on a completely different stream link from the one that has been scheduled previously. But we'll make sure that the recording gets shared and it will be shared as a separate podcast as well. I do have one final question, Andrew, which is kind of your future plans, the $1 billion market. Where do you see the next big opportunity, and how does media capital align with the overall company strategy?
Yeah, we're at a pivotal time in the UK where our ambition is to become the number one pet wellness brand. And that doesn't just mean trackers and activity monitors. That means food, insurance, treatments, the full kind of ecosystem to keep your dog happy and healthy. We've got our food now. Our link here is we can tell you how much to feed based on your dog's exercise. Got fantastic high quality food. Dogs love it. That's beginning to really ramp up. The next thing for us is launching our insurance, where your premium and things like your excess and contribution is linked to the activity of your dog. So that's launching in the next few weeks, which again moves us closer to that brand promise of keeping your dog happy, healthy, and safe. We're timing all of this with a TV because we want to become that prominent pet brand who can serve your dog in all of these different areas. So you'll probably see our GPS advertising towards Christmas, and then you'll see the more holistic brand there for your dog, there for your best friend, helping them live longer, happier, healthier life. That really is where the company is going. The key thing for us now is cementing our position as the number one pet wellness brand, and people just knowing that we can help your dog across all these different areas, and that if you link them all together, they get better because of PitPat.
Yeah. And I guess obviously PitPat is in the UK. I'm sure you ship the products to other markets. Are you looking into any new geographies into 2024?
Potentially, we still have 10 million dogs to conquer in the UK. We've got growing market penetration here. Our focus at the minute is going really deep in our home market and really demonstrating the food, the insurance, the platform. At that point, we will know exactly what our lifetime value is, and we'll be able to make the business case for investing in outside markets. But for the time being, there's still 9+ million dogs without a PitPat on in the UK to conquer.
No, absolutely. As a pet lover and pet owner, I think it's a really fascinating space, and we've seen a lot of investments actually in the sector, and a lot of attention from media investors into the sector. Thank you so much again, Andrew, for tuning in.
My pleasure.
Thanks so much for listening. I hope you enjoy the show. You can find the full video episode on YouTube on the Media for Growth channel, or you can listen to it on Spotify, Google, or Apple Podcast. And let us know what you think by leaving a review. The full script and more investment insights are available via our Media for Growth monthly newsletter. See you next time.